In this video, we're going to talk about Bionano Genomics, trading under the ticker symbol Bngo. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are recorded, uploaded, and how much they react to the latest market updates. So most of my videos are recorded and scheduled the day before and uploaded for the next day. For 5 days out of 7, it's a trading day, so of course by the time the video goes live on my channel, the price would have already evolved from there. If there are significant and very volatile movements during the trading day, obviously they will not appear in the video on that day. But usually, to the extent possible, my analysis will be based on the medium term and not really focused on the intraday movements. The reason why it shouldn't matter that much either way is because most people investing in stocks invest for some kind of reason that takes time to get developed, and that their positions are usually kept for at least a few weeks. With that being said, if there are significant stock price movements that happen afterwards, either they will not affect the overall picture, or if they're significant enough, they will be mentioned in the next video about the stock, with reevaluations of the circumstances as needed. Bionano Genomics is a startup operating in the genomics sector and has been a popular stock to pick and a popular topic of conversation ever since late 2020, after the company managed to develop tests that are better and more affordable than its rivals. This was mentioned in the scientific magazines and picked up by ARK Invest, managed by Cathie Wood. This was a really major event for the stock because it attracted the attention of retail traders. Its appeal is the fact that Bngo seems to have a lead in the sector, and the sector itself is considered to be on the road of becoming something of a lot more significant in the years to come. The market cap of Bionano Genomics is currently at $1.5 billion, and the enterprise value is at $1.7 billion. This means that there is a slight, well, actually not that slight, discount between how much the market believes the company is worth and how much the company has assets worth at that price if they were sold. The market cap is indeed the price tag the financial market is willing to pay for a piece of the stock today, considering its future potentials as well as the short-term fundamentals. The enterprise value of the company is the net result of the company's assets once all the debts are paid back. Usually the market cap is higher than the enterprise value, but sometimes there may be exceptions because the company may be highly leveraged or under short pressure. In this case, I think it's just because, the interest went away, and this is like a low for the company for the time being. The quick ratio of Bionano Genomics is 31.41. The current ratio is 31.87, and the debt over equity is 0. So the company doesn't really have any sort of debt and is very liquid. So this is a good news for the shareholders. The average trading volume of Bionano Genomics has been 11.71 million shares, and the daily volumes in the recent days have been around like 8 millions, 9 millions, and 12.2 million shares. So it's fairly traded, and I would say that the interest, even if not at the highest, is also not that low. The 1-year beta of Bionano Genomics is 1.47. This means that compared to the rest of the market, the stock is 47% more volatile. Its 52-week high has been $15.70, and its 52-week low has been just 48 cents. Now, let's talk about the options for Bionano Genomics. In terms of volume and open interest, the options market seems to have made a decision to favor the call options in a very clear way. Generally speaking, the put options mean that the market expects a pullback, and the calls options mean that the market expects an upward tendency. The key strike prices where there seems to be the most interest are $5, $6, and $7. So the overall price evolution of Bionano Genomics since the hype days make me believe that we should remain prudently optimistic. Prudently because the price has barely moved since quite a few months by now, hovering around the $5 mark. But we should also be optimistic at the same time for the same reason. As the price was able to maintain itself around the same level during those months where the interest of retail investors has clearly gone to other places, such as short squeeze stocks and hype coins. So what this means is that the price of Bionano Genomics has truly been stabilized after many months of sell-offs, and how it may be ripe to buy for the potential uptick in the future. There is no catalyst in sight, but my opinion is that in terms of probability, there is a fair amount of possibility that the stock will see its price increase in the future rather than the other way around. I would suggest to keep a position in Bionano Genomics within 5% of your portfolio. In the current market environment, I think that we should be careful about taking positions in the financial market in general, especially when it comes to equity market. Over the past decade or so, the financial market has been living with the help of newly created capital from the quantitative easings, which resulted in the increase of asset prices and the corresponding collapse of their yields. Of course, the low interest rate also contributed to reinforce that phenomenon because the financial sector would first of all see its profit margin squeezed, which will in turn keep the returns of other sectors low as well. At the same time, the market doesn't represent the real economy, and the real economy often doesn't get reflected in the prices of their own securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. And I want to say that fundamentals sometimes doesn't play that much of a role at all. If the asset prices only depend on the fundamentals, then their performances in Northern Hemisphere would have been more than mediocre, because things have mostly been stagnant over the years, ever since the last economic recession. A few things can explain why asset prices managed to remain high during these years, despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their local economies. But because that money is distributed to banks and expected to be loaned to businesses, and that there aren't that many opportunities in the real world, the money went into the financial sector to buy up assets. Of course, the QEs are wrapping up in many countries, so for the next couple of years, it's not going to be the main driving force to keep the asset price high. But it's compensated by the arrival of new capital from different regions in North America because it's still perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be a sustained phenomenon over the years to come. The last phenomenon is the creation of artificial bubbles that are either supported by the real market trends or completely fictional to allow market participants to play the game of hot potato and to either generate profit or to safekeep their capital. Of course, the people who end up with the hot potato lose money, but that's another story. The EV sector in 2020 is an excellent example of this. Nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially in Asia. This means that the market is expected to see its volatility increasing over time, which will provide opportunities to make a profit or to incur losses depending on the timing and risk management of those portfolios. Another thing to note for this period of time is to be very careful with having short positions. Usually, it's already more risky than having long positions because losses are not limited. And with the increased involvement of retail traders, I believe that the stocks being shorted will have a higher probability of getting squeezed, and this will occur randomly, which will result in potentially massive losses. We're also observing very often people will choose to rush in positions not necessarily because the fundamentals are convincing, but because there is a buildup of demand in a specific stock and that people will pile in to ride the gravy train with the rest of us. This kind of behavior is highly risky and may result in heavy losses as well. It's worth pointing out that in 2020 and probably in 2021 as well, the financial market has never presented that many opportunities, but it's also during this period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. The positions should also begin small so that there is an opportunity to average down later. Typically, the growth stocks would take about 5 to 10% in my portfolio overall, and each and every one of them represents maximum 1% of my portfolio. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.